Welcome to Life by Design, where Dr. Alex Tam interviews real estate investors, delving into their experiences and insights. Get ready to uncover the secrets behind successful real estate investing and discover how it can shape your life.
You need to select your sponsors and your passive investment opportunities carefully. Sponsors need to really have a good internal look at whether or not they're qualified to take on this responsibility. And now there's some coming to Jesus moments for some people. You should be able to work with the sponsor to get justification and support for every assumption that they're making. And if they're unable to provide that, then I would consider that might be a red flag. And so we were able to win all the way across the board. Our losers were winners and our winners were grand slams. So it was really fortunate that we picked the timing that we did to start making some of those exits. Real estate is still a very viable channel for you to invest in. You just have to be patient and do it right and just be careful.
Alex Tam here from Life by Design through Real Estate Investing. I am so excited to share this next podcast. Our guest is no other than Mr. Brian Burke. He's been in the real estate industry for over 33 years, 34th year this year. And he has been a top-notch syndicator, the author of The Hands-Off Investor, which is what I recommend to investors to read. I'm super, super excited and stoked to have him on the show. So here we go. Well, welcome everyone to the Life by Design podcast. We have Brian Burke on the show. I'm so excited to have Brian to interview him because his book, The Hands-Off Investor, is one of the books that I recommend to all of our passive investors. And Brian's company, Praxis, is one of the best syndication companies, real estate companies that have sustained the life of many cycles. So, Brian, thank you so much for being on the show. Welcome.
Thanks, Alex. It's really a pleasure to be here.
Yeah. So, Brian, people could read about your bio, but I like to hear it from you. How you built this amazing, massive company, and you're only about an hour or so away from where my practice is. How did you get started, Brian, in real estate and doing what you do so successfully too? Well,
I got started small time. Like a lot of people that get into this business, they do a small real estate deal for themselves, and then they just grow the business organically over time. This company has grown completely organically, all the way from my first $100,000 house flip 34 years ago to buying $150 million apartment deals, more recently. So it's just been a straight growth pattern that's taken a lot of decades to get here, but a lot of house flipping and then a lot of apartment buying has been how I got from one side to the other.
How did you, when you first started with house flipping, it's not uncommon for real estate investors initially to do some house flipping. How did you realize apartment buying was going to be the thing that you switched to?
Well, at first I was looking for just a personal investment and having passive cash flow. And, I had been to seminars and stuff that tell you, having one roof is better than 5 roofs, right? So it made sense to have more economy of scale. And so I started, my first apartment investment was a 1031 exchange where I took 2 rental houses that I had acquired and sold them both and did a 1031 exchange into a 16-unit apartment building. And that was really my first entrant into multifamily. And I had to learn, it was trial by fire. I didn't really know what I was doing. And I had to learn as I went. And it just never stopped. Once I got in there and really figured out how to do it right, I just learned that really was a business that was scalable and sustainable. And it would be a good business to be in for the long haul versus house flipping, which comes and goes in waves. And I wanted something I thought could be a little bit more consistent.
And at what point, Brian, did you start bringing in investors? At what point of your journey?
Yeah, fairly early on. I had started bringing in investors for my house flipping business about 20 something years ago. I brought in investors to expand and grow the house flipping business. And then about 10 years, about maybe 15 years ago, Yeah, it was like right after the big financial collapse, right?
Right.
My house flipping business just completely exploded and became like from, a small time business to doing over 100 houses a year. And,
Wow.
and to do 100 houses a year in the San Francisco Bay Area required a lot of capital. So I had to raise a lot of money to grow the business to that scale. And after having done that, I realized like, we were buying a lot of foreclosed houses, and you
Right.
start thinking about how sooner or later all these foreclosures are going to be gone, and I've got all these investors, and what are we going to do next? And multifamily was a good place to start directing that capital towards. And so it's probably about 15 years ago, started, really focusing on, raising larger sums of capital for the multifamily side of the business.
And does your company, where do you guys focus? Knowing that you guys are out of California with multifamily, where do you guys focus?
We have almost a national footprint right now. We
Wow.
currently own in Arizona, Alabama, and Georgia, but we've also owned in Florida and several other places as well on a smaller scale. But the team that I have here with me, the senior level folks here at Praxis have over 100,000 units of multifamily experience in probably more states than not. So we've got
Right.
operating experience all across the country, and we're looking at deals all across the country in markets where we can find a really good reason to be there. So it's given us a pretty broad footprint.
That's wonderful. Now, because you have such an experienced team and you've seen, you got into this 15 years ago with multifamily, you've seen the cycle, right? And that's one of the big questions I'd like to ask you today on what do you see moving forward in the next few years that was completely different than what has happened the last 3 to 5 years? What is your take on that?
Yeah, I've managed to see a lot of cycles. When I first got into multi 20 years ago, the 2006 collapse hadn't even happened yet. So I had to survive through that and watch property values go up and then watch them go down to less than I'd paid for them and then back up again. And so, I've seen this movie before, and in a lot of ways it's playing out in similar ways. I think it's really important to, some people will say timing doesn't matter in real estate investments. I've heard some people say, like set it and forget it, or just, don't wait to buy real estate and wait. That's another one I've heard.
Right, right. Like any time's a good time, right? Stop waiting on the sidelines.
That's right. Every time is a good time to buy. And that's an old famous real estate agent saying, right? It's always a good time to buy. And I just don't see it that way. I mean, I see like there's good times to buy, there's good times to sell, there's good times to sit on the sidelines and hold, and there's good times to go play golf. Mm-hmm. And right now I think this has been a good time to go play golf. We bought several thousand units in like 2016, 17, 18, 19, and we sold several thousand units. In fact, I sold 3/4 of my portfolio in 2021 and the early part of 2022.
Wow.
So
great timing.
Very, very good timing. I mean, we got out right at the top of the market because we saw this coming. Like I said, I've seen this movie before. We saw warning signs coming that the market was going to change and things were not going to be as good. So we aggressively sold a lot of our portfolio, and we haven't bought anything in over a year and a half.
Right.
And I wouldn't be surprised if we don't buy anything for another year and a half. I mean, times are different now. For the last 10 years, it's only been an up market. Anybody that's been syndicating multi less than 10 or 15 years has only seen a really good market. And it's not like that now. Now it's much more difficult. Rent growth has slowed, borrowing costs are up, insurance is up, payroll is up, and it's just becoming a more difficult climate in which to operate. And this is the time when the kind of the who's who gets separated from one another.
Now, a lot of people that I've talked to, they're like, well, it's still a good time to buy, or maybe you should look into self-storage, Airbnbs, and everyone's trying to grab different things. And to my knowledge, some people are trying to get like the acquisition fees, or they're just trying to get it, management fees or whatnot. What is your take on people who are still buying aggressively right now? And what should a passive investor, right, be really cautious about right now during times like this when you're saying, hey, go play golf, and then they see other people who are still buying very aggressively?
Yeah, I mean, I personally, I worry a lot about any groups that are buying aggressively right now. It's difficult to kind of take them very seriously because this just is, there's a lot of theories, right? And there's differing opinions across the board. I suppose the groups that are buying right now are of the opinion that prices are down and this is a really good time to get in. And history may show after this is all played out that they were right, and that they were the smart ones. I might be the foolish one for sitting on the sidelines, but I don't think this is the time to be buying right now. I think there's a little bit more heartache we all have to go through before we start to see good times again. And this is a good time for passive investors to be vetting sponsorship groups to figure out who they want to be investing in. And there's some interesting questions they can ask now that they couldn't ask before. Like, are you guys issuing capital calls? How is your portfolio performing? I mean, these are questions that would have been meaningless. Everybody would have had the same answer a year ago. But now you're going to get differing answers, or you're going to get no answers at all, or maybe you won't get truthful answers. It's hard to say. But I think this is a difficult time. And yes, I would say some shops may have created a big mouth to feed. They have a lot of overhead, and they need to be able to cover that expense. And so therefore they're still acquiring real estate to earn fees to do that. And again, that could turn out to be the smart move. Only time will tell. Right.
So with your team, because you guys haven't been able to or haven't acquired for the last year and a half or so, right? What happens to those people? Or they, your team they're just everyone's okay with what you guys have right now? How does that work?
Well, we have a couple of advantages. One is that we never grew very large. We've always been a fairly small shop. Despite the fact that we have a pretty large footprint and we've had a sizable assets under management, we've only got a core team of about 6 people. It doesn't take much to operate something like this if you do it right. And so we didn't have to, have this big thing where we scaled up really big and now we have all these people to pay and all this other stuff. So that's one advantage that we have. The other advantage is that we saw this market coming and we started selling. And, when you sell and you perform really well, you'll do pretty well.
Yeah.
And we were able to do well and, be able to stash some cash, so to speak, so that we can get through until times are better again. And, I can wait this out for years. I don't have to do anything at all for quite some time to keep the lights on here. And that's really a good place to be, because I don't want to be under the pressure of saying like, oh, well, we have to buy something or otherwise, we're not going to be able to afford the office lease or something crazy.
Right, right. Now, earlier you mentioned, Brian, a capital call. Explain to our listeners, what is a capital call and what triggers a capital call?
A capital call is when a syndication sponsor asks the investors for more money after the initial investment's been made. Now, there's 2 kinds of capital calls. There's planned capital calls and unplanned capital calls. If you've invested in a fund, let's say you invest, you commit $100,000 to a fund and they're going to buy multiple assets. What the fund will generally do is they'll issue you capital calls for your investments to be submitted. So, okay, we bought an asset, send in $25,000. We bought another one, send in $30,000 until you get to your 100. That's normal. So there's nothing abnormal about those types of capital calls. Unplanned capital calls, on the other hand, is bad news. This is when you say like, okay, we raised $5 million for this apartment deal and we have $50,000 left and the property is in negative cash flow and we're going to run out of money. If you guys don't send in some more money, then the property might end up in foreclosure, or we won't be able to complete the renovation plan, or some other kind of bad thing is going to happen if we don't get more cash. those unplanned capital calls are not fun for anyone. They're not fun for sponsors that issue them, and I'm sure, and they're not fun for investors. And 5 years ago, heck, even 2 years ago, if you asked any passive investor if they've ever had a sponsor issue an unplanned capital call, I would say 99% of the people you would talk to would say no. If you ask the same question of the sponsors, most of them would say they've never issued one. I can say in the 34 years we've been in business, we've never issued an unplanned capital call. But you're starting to see a lot more of that nowadays. I'm getting calls from several investors who are invested across multiple sponsors who are saying like, hey, I'm invested in this deal with sponsor X and they're issuing a capital call, should I fulfill it or what should I do? And the investor doesn't have to send in the money. In most cases, the language of the operating agreement says that if the if the investor does not wish to submit additional capital, they don't have to. But that'll have bad implications one way or another. Either the sponsor doesn't get the money they need and the property ends up in foreclosure anyway, or the sponsor has to go raise money from new investors, thereby diluting existing investors. And either of those cases could be, what might happen.
And when a property goes into foreclosure, right, what actually happens to the investor's money?
It depends. In most cases, it's gone. We sold a portfolio of 2 properties together I guess about a year and a half ago. And I got a call from the broker that sold them for us about 3 months ago. And she said that the sponsor was looking to sell the properties that we had sold them. And so they did a BPO, which is a broker price opinion. It means they look at the financials and they look at the property and they give the owner a sense of what the property is worth. It's kind of like an appraisal, but done by a broker.
Yeah.
She said we did a BPO on the 2 properties and our valuation was less than their loan amount. So what that means is that the property is worth less than the loan, so all of the investor's equity is completely wiped out. Now, assuming that they don't sell or they don't lose it in foreclosure and they hold and they can wait long enough until the market comes back, then maybe that equity isn't all lost. It's like if you bought shares of stock and the stock price went down, do you have a loss? Well, if you don't sell, you only have a paper loss. Well, so right now the investors are in a paper loss, 100% wipeout scenario. Only time will tell whether they actually lose money or not. But if they have to sell the property for less than the loan amount or the lender forecloses, then all of that investor equity is gone. And this is why people need to take it very seriously. I think there's been a cavalier attitude over the last 5 years on behalf of both sponsors and passive investors that you don't really have to be very careful. As a passive investor, I can invest with anybody and, I'll be fine, and there's been a sense from the sponsors like, oh, this isn't really that big of a deal. I'm raising all this money and it's not that hard. I just go buy a property and then a few years later I sell it and we all make a ton of money. And now people are starting to realize that, this isn't a cavalier decision and it's not a cavalier responsibility. You need to select your sponsors and your passive investment opportunities carefully. Sponsors need to really have a good internal look at whether or not they're qualified to take on this responsibility. And now there's some coming to Jesus moments for some people. Right.
No, we're these capital calls, the unplanned ones. We are definitely seeing that in the market. When you hear it, it's like, oh my gosh, so and so's having a capital call. Whoa, what happened? Right. Now, how would a passive investor, how do they vet? Like someone, when I first started, I tell you, I had zero idea until I got the education. I didn't even know that there were different roles, right? What a cap rate and all that was. As a passive investor, how did they even vet if they don't have the experience?
Well, they should start by following your recommendation and getting the book.
Read your book.
Because there are 350 pages in there about what things they should be doing, and a lot of people don't. I think sponsor selection is critical. Who you're investing with probably makes more difference than almost anything else. The second thing is capital structure. Over the last 4 or 5 years, it's been very commonplace for sponsorship groups to acquire multifamily assets with bridge financing that's high loan to value. And they do that so that they have to raise less equity. And that's for two reasons. One is maybe they don't know enough investors to raise more equity. So they take on more debt, so they have to raise less equity. And then the other side of it is the more debt you bring on, the more you amplify your results, and therefore you could promise higher projected returns. I shouldn't say the word promise. I should say you can project higher returns because you have more leverage, but that knife cuts both ways. It also amplifies the downside. And so I think the kind of capital structure the deal has that you're getting into is a very important decision for you to make. If there's high loan to value ratios, that implies that there's a high degree of risk. And if that exceeds your risk tolerance, you might not want to play in that field. So look at who you're investing with and how they're financing that deal. Those two things are extraordinarily important.
With your experience, Brian, what is the financing terms that you think a passive investor, should it be like a 80-20, 75-25? What should an investor look for?
I don't like anything over 75 personally. I like under 70 is even better. But I think going into the deal at the time that they acquire it, I think 75 is a good cap, on the higher end of a good cap. I think when you look at what the loan to value ratio is relative to the property's value, like say in year 2, I mean, you should be kind of in that 50% range is where you'd want to see it. And that one's a little bit more subjective, but if you start out higher than 75, you're kind of already playing behind the 8 ball a little bit.
Right.
And it can be a difficult hole to crawl out of if things don't go according to plan.
Right. Wow. Thank you for giving so much insight, on this. But like I said, I do recommend your book. It just gives people so much, those who really want to learn, it gives them an edge compared to those who just invest blindly, right? But there's also, I've seen a lot of people that invest blindly on, oh yeah, it sounds like a good deal. Someone would project 15% IRR, 7% preferred return, and 2x multiple in 5 years. Today, still, compared to what you're saying, we haven't gotten anything that think that we could get that type of return in a while. And what else should they be asking besides vetting the sponsor, looking at the debt? Is there anything else they should be looking for? Any red flags?
Well, I think they should be looking at the projections in the financial model. What kind of rent growth is being used in the financial projections? What is the exit cap rate? In other words, what cap rate is being used to determine the sale price of the property when the exit is being planned? The various inputs and assumptions that are made in the financial modeling is how those projected returns come to be. And I call this the shiny object syndrome.
Yeah.
It's kind of like exactly what you're talking about, where people will make investment decisions based upon the highest projected return. And I think this comes from the crowdfunding era, right? Where you could literally go to a website, have a menu of 20 different investment options you can invest in. And human nature is you scan through the list until you find the one that has the highest projected return. And you say, that's the one I'm going to invest in because that's the best one because it has the highest projected return. Forgetting completely that, the sponsor may be incompetent. They may have a math error, or it's just kind of garbage in, garbage out. What were the inputs that the sponsor used in the calculations that produce the output that you're making as a basis for your selection? I think that's extraordinarily important and oftentimes overlooked.
And so does that mean a passive investor should go online to figure out, hey, is the projections even correct? Or do they just figure out, maybe I should just trust the sponsor?
Well, you don't even necessarily have to go online. If you're investing with a good sponsor, the sponsor should be helping you. And one of the ways that they can help you is to provide some justification for the projections that they're making. So let's say, for example, the calculations are based upon 8% rent growth, 8% annual rent growth. Well, you might sit back and say, well, of 8%, that's ridiculous. That it could never be that high. That's just not a thing. But in fact, that could be low. Now, I would argue today that's probably extraordinarily high. I mean, the U.S. average right now is 2.9% projected rent growth on a go-forward basis. So whatever projection is being made, you can ask the sponsor, show me some justification for the rent growth projection that you're making. There's third-party data services out there that have economists that study every facet of the multifamily market, including asking rents versus actual street rents, concessions, job growth, units under construction absorption ratios, and they make estimates of rent growth projections on a sub-market basis. And a sub-market could be as small as a zip code or sometimes even smaller. And, if the sponsor has this data that they can show you, that's certainly a lot more helpful than just, oh yeah, we're projecting 7% rent growth. It's like, well, support that with something, right? Give me a news article that says a major employer is coming in and about to build this huge plant and they're going to have thousands of new jobs. How is it that you're arriving at this number? So it shouldn't be like where you should even have to go online. You should be able to work with the sponsor to get justification and support for every assumption that they're making. And if they're unable to provide that, then I would consider that might be a red flag.
Thank you for sharing that. That is really insightful. Now, Brian, at what point does you and your company decide to get back in it? Or are you guys always analyzing? What's the deal there?
We're always analyzing because the only way you can really make a decision is to be a participant.
Right.
Now, we don't have to transact to be a participant, but we certainly do have to analyze numbers, look at all these different deals, follow them through to see, okay, we didn't bid on that one. We were at this price. What did it really go for? How far off were we? And, we'll start to see when our price gets a little closer to the actual price. Right now, they're so far apart that there's not even really any use trying. We haven't written an offer on anything in, I don't even know, well over a year. But we are looking at a lot of things and being ready for it. I mean, the only way you really get these signals is to kind of sense the activity around you. I mean, this is how we predicted the top of the market. Is we had an unsolicited offer come in on one of our properties, and we thought, you know what? Let's give this a try and see what happens. So we told our broker, let's just put this property out to market. If somebody wants to give us this price, let's see what happens if we take it out to market. So we did. We took it out to market and we got dozens of offers. It was like 30-something offers, way over what we had imagined it was going to sell for, with some offers having over 6-digit non-refundable earnest money deposits day one at the time of signing the contract. And we thought, you know what? Couple that with our experience trying to buy stuff where we literally are, we go in over what we think the pricing guidance is. We really push all of our projections, and yet we still come in like 12th. When you see that kind of stuff happening, we're like, something's going on and we need to take advantage of this, because if everybody wants to buy, we should be selling them something. Because that's what you do when everybody wants something, is you give them what they want. Right. So we took our properties out to market, and we're very happy that we did. Now, had we not, experimented, or had we not also been buyers that were trying to buy and we're not even getting close, we wouldn't have known that the market was going completely insane. Right. So you really have to be a participant.
Absolutely. And I'm sure that because you guys are so experienced and saw that happening, was active in the market, you end up with a lot of happy investors.
We did, yes. Nobody was sad when they got some really, really hefty returns. And nobody was sad when we had deals that weren't doing all that great that we were able to sell out of. And, even if they make a small return, it's like no matter who you are or how hard you work in this business, you have some deals that are dogs. And to be able to get out of those and come out clean is a win. And so we were able to win all the way across the board. Our losers were winners and our winners were grand slams. So it was really fortunate that we picked the timing that we did to start making some of those exits.
That's awesome, Brian. Thank you so much for sharing the insight once again. In the event, when people want to invest with you and your company, What's the next step? What's naturally the next step?
Well, probably to be patient because it might be a while before they have a lot of opportunities to invest with us. But I'd say the first thing to do is go to our website, praxcap.com. It's praxcap.com. Check that out. Click on the Let's Talk button. Set up a call with Bob or Haley in our investor relations department, and they'll kind of tell you about what our thoughts are on the market, what's going on here, get you on the list so that you know about when opportunities do come about. There are some things that we're doing. We are doing a debt fund right now, and we've got a few irons in the fire, but we don't expect to be doing any real estate acquisition anytime too soon. But then again, we're focused really on producing the highest and best return we can for our investors, and the time value of money is a very important component of that return. So we may wait until it's a little bit later in the recovery before we really jump back in, or we might find a great opportunity day after tomorrow that like nobody saw coming, and is a complete distress situation. You just never know how this stuff plays out, so you just kind of always have to be ready.
Absolutely. Well, I bet your investors really appreciate that, knowing that you're not just going to jump in at any moment, no shiny object syndrome from your company. So I really, really appreciate you sharing everything that you did today, Brian. Thank you so much. Is there any last minute, with your experience, last minute things you like to say, share with our audience, any insights for the future, anything like that?
I think like for the last 10 years, investing as a passive investor has been extraordinarily easy. You could pick sponsors, you could pick deals, and no matter what you picked, you're probably going to come out okay. Now is a time when you need to just take a step back, make a really informed decision with some good data and some good research and some good due diligence. And if you do that, this is still a great alternative investment to be investing in. There's a lot of things you can do with your money. You can put it in a CD or a money market or a bond or stocks or real estate. Real estate is still a very viable channel for you to invest in. You just have to be patient and do it right and just be careful.
Awesome. Brian, thank you so much for sharing everything. Thank you for being on the show today. I know that our listeners have learned a lot. And if not, they want to get more from you, I'm sure they'll get that book. I'll put the link below.
Yeah, check out the book, and you can follow me on Instagram at Investor Brian Burke and get some more insights there once in a while.
Perfect, Brian. Thank you so much for being on here. Have a great day.
Thanks for having me. Thank you.
For those of you who have really enjoyed the insights that Brian has shared with us, make sure you subscribe to our channel for future podcasts just like this. If you want to watch it again or other ones, click here or here. We'll see you guys soon.